Welcome to this lecture on trading in financial markets. So what's the idea of this lecture? What I will do in this lecture, I will basically discuss the basics that you need to know before we go more into depth into understanding risk management and the usage of financial products. So what will be the discussion about today? I will discuss what trading actually entails, how financial markets work, what kind of financial markets are there. And once I've discussed the market and the way that markets function, I will go to the most basic derivative securities that are applied commonly to manage financial risk. And these derivatives that I will discuss are forward contracts, futures contracts, which basically deal with a deferred sale. You already agreed today upon a sale that will occur in the future. I will discuss swaps and I will discuss options. So let's start with the first part, trading. What is actually trading? Trading in the context of a financial institution has to do with the buy and sell of financial instruments. And if I talk about financial instruments, then you really need to think about financial instruments such as stocks and bonds, which are the basic financial instruments that we know. And there are the derivative securities that also frequently now are traded. And the most important ones there are the forward, the futures, the swaps, and the options. But there are many other ones. So from the perspective of a financial institution, and we will always take the perspective of a financial institution, the question rises, well, why does a financial institution think, when I say financial institution, think, for example, of a bank? Why do they actually trade? And there are many different reasons for that. Well, first of all, they need to satisfy the request, the needs of their clients. So there may be large corporations which are exposed to, for example, currency risk or interest rate risk. They reach out to a bank where the bank acts as a market maker and say, well, could you please help me to reduce this risk that I have? So that may be one of the reasons why the financial institution then actually becomes active in the financial market. Second of all, given that a financial institution, think again, a bank, is trading with many different of its clients, it also means that given that it's a market maker, so it always facilitates a trade with its clients, it means that it builds up a portfolio itself that in itself may be risky. And so in the end, it also needs to manage the risk of that own banking book that it has, the investment book that it has. So that's the second reason, and we will go extensively be looking into that. It's the second reason why banks and financial institutions say trade in financial instruments. Then there are two other reasons why a financial institution may be, say, active in the financial markets. And the third reason that is noted here, it has to do with arbitrage opportunities that it wants to exploit. And what I mean by that is that financial instruments may be traded in different markets, and there may be an opportunity to buy the financial instrument at a low price in one market and sell it at a higher price in the other market. Very often, if it's already the case that these opportunities exist, the difference is small, but so if you could say then still trade large volumes, then there is still an opportunity to make money there. And the fourth reason why a financial institution may be traded on a financial market has to do with actually the vision that it has, so that it may have superior understanding on what the direction of market prices will be. So if it has a strong view on what direction financial prices may develop in the future, it may take a position, a long position, will buy an asset today if it believes that the asset will rise in price in the upcoming period, or it will sell an asset, go an asset short if it believes that the price will deteriorate. So we call this a speculation, and it's the third and the fourth reason that I mentioned. So both arbitrage opportunities and in particular speculation that have become less attractive, or at least say so where the regulator is less in favor that a financial institution takes care of. So what the regulator does, it says, well, you as a financial institution, you as a bank, you have a role to play in this world. Your role is that you facilitate your clients to help them to mitigate their risk. That's why you offer them financial products. And in addition to that, we would like you, dear bank, to manage your own risk. So it's the first and the second reason where the regulator is very much in favor that the emphasis is. And the third and the fourth reason, it's in fact alternative ways in which a financial institution may seek to pursue future profits, where there is less appetite with the regulator that it pursues these ideas. So in the following, when we talk about the financial markets, it's in particular the alternative instruments that I will go and discuss. I will give you a high-level idea of what kind of markets exist. There will be a distinction between an exchange-traded market and an over-the-counter market, which I will discuss shortly. And there will be, if you actually look to the real operational execution of a trade between two parties, there is a lot more going on than simply the one party handing over a security to another party and there is an exchange of money. There is a more sophisticated operational system around it. And one of the elements in there is the requirements of a margin, and also that I will discuss in a minute. So to begin with, what kind of markets are there to trade financial products? The most common market that exists is an exchange-traded market. And an exchange-traded market, really what's going on there is that there are standardized products on this market, and both buyers and sellers can go to this market and can see what kind of financial instrument, say what kind of contract that they would like to say buy or sell. And then it's the role of the exchange is to facilitate such a trade, so to make sure that the request of both the buyers and the sellers in this market are honored. And so what the exchange actually does is that it makes sure that the execution goes right. That's the operational process, which I will discuss in a minute, which flows through market maker and a clearing house. But it also makes sure that the proper products are in fact defined and are traded on the market. So it has a good idea of, well, what is the actual need? So what are the standardized products that should be available in this market? I already mentioned it a couple of times. Some of the players in this market, very often these are the larger players, think of investment banks, for example. They are active in these exchange-traded markets, and they assume the role of market maker. And what a market maker really does is that it's always prepared to trade with a counterparty. So if there is a large corporation or even a small corporation who is in need of a financial product, it goes to the exchange market, it reaches out to one of these market makers, very often one of the larger banks, and it states its request. Well, the bank, the market maker, is always prepared to trade, as I said, and so what it will do is it will quote both a bid price and an ask price. And the bid price is the price at which the market maker is always prepared to buy a financial instrument. And typically what you will see is that the price that the market maker quotes to buy a financial instrument is relatively a low price. Then at the same time, the market maker is also prepared to sell a financial instrument. It will quote a different price for that, and we call that the ask price. And obviously, the market maker is prepared to sell a financial instrument at a high price. So what the market maker does is it tries to buy at low prices and it tries to sell at high prices. And it's the difference between the bid and the ask price. So the ask price being higher than the bid price, the difference between the two we call the spread. And it's typically the spread that the market maker seeks to earn. So it engages in many trades. And if there is a sufficient market, it sufficiently often buys and sells financial instruments. And in the end, it picks up the spread between the bid and the ask spread. Second market is what we call the over-the-counter market. In the over-the-counter market, there's far less standardization. So you have to think of the over-the-counter market as a huge network of traders who work for large financial institutions, or they work for large corporations, or they work for fund managers. And so there are no standardized contracts so much in this market, but it concerns more tailor-made agreements. And what I mean by a tailor-made agreement is that there is a very specific need that a client has, and there is a counterparty who is able to meet this very specific need. So not a standardized contract that, say, would be available to many parties in the market, but a very specific one which really is tailored to the needs of a single customer. So it's a relationship between one party and the other party. It involves many legal wordings to be exactly clear on what exactly the agreements are. And other than that, in this market, again, there are the banks who often assume the role as market makers. So again, they are prepared to buy or to sell, say, whatever the need of another trader is in this market. So they are prepared to offer a bid price and an ask price. Next to the fact that this concerns really a bilateral agreement, what we also see is that often these very specific needs entail, say, much larger trades in volume, so in number of dollars, than exchange trades. So we have discussed both markets. So we know that traders get involved in these markets and that there are market makers who play the role of making sure that there's always a buy and a sell opportunity for traders. So that's what we call making sure that the market is liquid and that there is sufficient activity, that actually prices always are available to buy and sell financial instruments. So that's one important element of a market. The second important element of the market is that there should be an official operational execution of a trade. And whenever a trade occurs between two parties, there's always the risk that at a point in time, one of the two parties does not honor the agreements under the contract. And in order to mitigate this risk, which we will call credit risk, what in particular in an exchange traded market has been activated, which has become say, a usual way of doing deals, is the establishment of a clearinghouse. So if there are two parties who say, where one party wants to buy a particular financial instrument and the other party wants to sell the particular instrument, then how the exchange traded market works is that these two parties are not dealing with each other directly, but there will always be a clearinghouse in between them. So there is one party that deals with the clearinghouse to buy a security, and there is another party that has a relationship with the clearinghouse to sell a security. So how does that clearinghouse actually work? So the clearinghouse has a relationship with a number of members. These are very specific traders in the market, and they are the only parties that directly, so the members are the only traders that directly can trade with the exchange. So non-members that are active in that same exchange, if they want to execute a trade, they still need to have that trade flown through the exchange, through the clearinghouse. And that means that the non-members first have to reach out to a member, and then the member will execute the trade with the clearinghouse on behalf of the non-member. So the nice thing about the establishment of a clearinghouse is that the credit risk is now no longer with a counterparty, but the credit risk is really taken care of by the clearinghouse. Well, so then if that risk is with the clearinghouse, then that risk needs to be mitigated. So what are the safeguards for the clearinghouse in order to assure that it will never, or say almost never, be exposed to risk? Well, first of all, these specific group of traders that we call members of the clearinghouse, they will contribute dollars to a guarantee fund, and this guarantee fund will be with the clearinghouse. So that will be managed by the clearinghouse. And it's there as a safety net in case that really something goes wrong and there would be a loss to the clearinghouse, and the clearinghouse could use that fund as an insurance, basically, to cover its losses. So that's one element. And the second element is that whenever a member wants to execute a trade with the clearinghouse, then the clearinghouse will demand, will impose a margin which will be flown into a margin account with the clearinghouse, which is basically a deposit of cash or marketable securities, so which will be earmarked. They are still owned by the member trader, but they are now in a safe position with the clearinghouse, and the clearinghouse will also use that as an additional safety guard for potential future losses that may occur. So whenever there is a contract that two members, or that a member will be entering into with the clearinghouse that has potential future liabilities, so there may be future losses that need to be covered, what the trading house will do, what the clearinghouse will do, it will ask for margin deposits, these percentage different, how much that need to be. So then there will be two safety guards for the clearinghouse in order to mitigate risk. So there is the guarantee fund, where all the members have been contributing, and there is the deposit of a margin in a margin account with the clearinghouse. This margin account, which is held by the member with the clearinghouse, it's also something that subsequently the member will impose with, for example, a non-member trader, or with an individual investor who reaches out to this member. So the usage of margin accounts, are frequently imposed, are frequently part of the deal when one party acts on behalf of another party to enter into a financial instrument. And we will see examples a little bit later on how this actually works. So the clearinghouse plays an important role in the operational execution of getting into trades. It assumes away it takes away all the credit risk that otherwise would be there between two counterparties. It assumes this credit risk, and to mitigate the risk, there will be the guarantee fund, and there will be the margin accounts held by the clearinghouse. The over-the-counter market very often, or usually, entails exchanges or agreements between two specific counterparties. These two counterparties also know each other. Nowadays, in over-the-counter market, there are also what we will call central counterparties, and some of these deals also could flow, instead of directly from one party to another party, could flow through these central counterparties. And then the central counterparties almost take the same role as the clearinghouse does in the exchange-traded market. So also here, these central counterparties, they all contribute to a guarantee fund, And in addition to that, they hold margin accounts with the central counterparties to limit the credit risk. So what we have seen is that because very often it's large banks that are active in the over-the-counter market, there is of course then still a credit risk. So what regulators have done, they have said, well, instead of having these one-to-one relationships between two parties to engage into a trade, where there's a lot of credit risk, we would like to mitigate that risk, and that's also why we want to have something similar in the over-the-counter market as we have in the exchange-traded market. So in the over-the-counter market, we call it central counterparties. In the exchange-traded market, we call it a clearinghouse. And we see that regulators, for example, already impose that standardized derivative securities between financial institutions are cleared through a central counterparty, through these central counterparties. Okay, so now we have more or less given a general idea of, say, what markets are and how they work. And the first thing that I now would like to do is I would like to look to a very simple buying or selling of an asset. And think, if I say asset, don't think of a derivative for the moment, but simply think of buying a stock or selling a stock, or buying a bond or selling a stock. So that's the most easiest thing that you could imagine, happening on the market. And what you will see is, if you look to the operation execution, it could be more sophisticated or complicated than simply, say, handing over the assets from one party to the other party, and then in exchange have the cash flowing to pay for that assets to the other party. But in everything that we will do in the future, and in the other parts of the course, that's of course what we will assume. But now, just on the next couple of slides, there will be a very exact description of how actually buying and selling of assets, of these simple assets, would occur. So an asset that in principle is bought by a party, and the party needs to provide cash to buy the assets. We call this a spot trade, and the word spot has to do with buying it on the spot, buying it immediately. So it's an asset that we buy today. That seems obvious, but the reason for calling it a spot trade is that there's also, and we will discuss that later, there's also forward trades where you actually agree today upon buying an asset at a later moment in time. So that's what we would call then a forward trade. But here, the easiest case, we look to a spot trade. And you could assume a long position in an asset or a short position in an asset. Whenever I talk about assuming a long position in an asset, it means that you buy the assets. And if you take a short position in an asset, then it means that you sell an asset. And you could also short sell an asset, which means that you want to sell an asset that you actually don't own. So let's look to simply buying an asset. If I buy an asset, so I'm an individual investor, I'm an institutional investor, and I want to buy an asset, what I will do is I will reach out to a broker, to a market maker, who I will request to buy the asset for me. So then what happens is that you do not really have to pay the full cash amount for the asset, because what the broker will do, it will tell you, well, I'm happy to buy the asset for you on margin. So as an investor, you always hold a margin account with a market maker, with a broker. And what the broker says as well, just simply pay half of the asset in cash, and then the asset will be owned by you, but you need to pledge it in the margin account. So you need to be certain that it's held by me. So everything that happens with the asset is still for your benefit, but it's sort of a guarantee in case things go wrong. So that's, say, from a liquidity standpoint, that's attractive to the buyer of the asset. So he only needs to provide 50% of the cash to buy the asset. Then the asset will flow to the margin account of the broker. And on top of that, what the broker will request is to hold, to say, well, so that's the margin account, but if the margin account, so the money that will be deposited there, so that's the half of the sales price, if that will be 25% or lower than 25% of the asset value of the asset, which could happen, of course, if the value of the asset drops once it's in the margin account, then there will be a margin call which says, well, you need to deposit extra cash in the margin account to facilitate that there's sufficient money as a security. So what actually happens if the broker allows for this buying on a margin is that there is the risk that the asset that has been earmarked and that has been pledged with in the margin account that's held by the broker, if the value of that asset decreases sharply in price, then of course, well, it still needs to cover half of the sales price, because only half of the sales price was actually provided in cash. So the other half has not been provided in cash, but may be provided later in cash. So that's the risk then actually for the broker, and that's why the margin account will be increased. There will be a margin call if the value is actually too low. So I have an example to illustrate that. Suppose, very easy, that a trader wants to buy 1,000 shares of a particular stock in this case, and that the price is 120. The spot price is $120 per share, and it wants to buy this asset on a margin. Well, then the margin account, the broker says, well, you only have to pay 50% in cash, which is 50% of these 1,000 shares times the price of $120, so which is $60,000. And on top of that, you need to pledge the asset as collateral. So it's owned by you, investor, but you need to keep it with me in an account, so where I will ring fence it. Nobody can touch it. I will not use it for any other things. So any dividend or price increases or price decreases are for your benefit. So whatever happens, but I take it as a security, as a guarantee in case that you will not honor future payments, because there is still $60,000 that need to be paid some moment in the future by the trader to the broker, because that is the full price. That's still then the full price for the asset is paid. So then this asset is held, well, the asset is owned by the investor, by the trader, but it's held in the margin account with the broker. And what the broker does, it simply looks on a daily basis what happens to the value of that share price. So originally it's $120, and whenever the price drops, then what the broker will do is it will transfer money, it will withdraw money from the margin account to itself, because it says, well, I need to still have the guarantee. So let's look to the example where there is a sharp drop in price. So originally the price is 120, then after a couple of days the share price drops to $78. Then what happens is that the broker withdraws from the margin account, which originally is $60,000. It withdraws $120 minus $78 times the 1,000 shares. It's $42,000, which means that there's actually $18,000 remaining in the margin account. Well, so the margin account includes $18,000 in cash. The shares that have been pledged with the broker have also decreased in value. So they are now only worth $78,000, where originally they were worth $120,000. So we are going to look, well, the cash that is remaining, the $18,000, as a percentage of the remaining share value of $78,000. That's 23.1%. Because this 23.1% is lower than the 25% that was required as a minimum cash amount in the margin account, there will be a margin call to bring the amount back to the 25%. So what the trader needs to add on a short-term basis, so the broker will tell the trader, please add 1.9% of the 78,000, which is $1,500, to the margin account. So then if the trader honors that request, then it would mean that the margin account will be $19,500. If not, so if the trader does not honor that request for whatever reason, so it cannot do it, then what the broker will do, it will say, well, then I will simply take the remaining assets, the remaining shares that are there, and I will sell them immediately. Well, the current price is $78,000. The broker already had withdrawn $42,000 from the margin account because there was a price decrease. So selling the shares for $78,000 and on top of that the $42,000 which was withdrawn in cash, and totally makes up the amount of $120,000, and this is exactly the amount that the broker was required to receive from the investor, from the trader, to honor the contract. So you see what the margin account facilitates is that at a moment in time where one of the parties does not honor the requirements of the margin account, the broker simply can stop the position, sell the assets that have been pledged, and then mitigate its risk. So there is no credit risk in this case because of the working of the margin account. Second thing, if we look to simply buying or selling assets, you could assume a short position in an asset, and you could even assume a position in an asset. You could sell an asset that you don't own. The way that it works is that the trader reaches out to the broker and says, well, I would like to sell an asset that I don't own. Usually an investor or trader would do that if it believes that prices will decrease in the future. What the broker will do, it will simply facilitate that by looking to any of its other clients and see, well, which of these clients have these assets in their margin accounts, and then will request them to get access to these assets and then exchange and sell them in the exchange. Usually a small amount, a small compensation needs to be paid for that, but at least in this way the broker could facilitate the sale of an asset that the client does not own. What happens then is that once the asset has been sold, then the money is owned by the investor who has issued the request, but it's not held by this investor. Instead, it will be deposited immediately in a margin account with the broker, and then so these proceeds and flow immediately in that margin account. So what could happen then in the future? There will be a moment in time where the trader will issue a new request to the broker, and this new request will be, well, you shorted this position for me, now please close that position by buying the asset in the market and by giving the asset then back to the party that you borrowed it from earlier. So sometimes the trader could be short squeezed, and what that means is that it could not simply determine the moment itself when it needs to give the asset back to the party that it borrowed it from, but so the broker has no alternatives anymore, but suddenly has a request that it needs to give the asset back, and then we call it short squeeze. So that's a risk that at an unfavorable moment in time, the party that instructed to go short needs to give the asset back and then needs to buy the asset at that moment in time in the market to give it back to the party that it was borrowed from. Once you have shorted an asset, so in case this asset is a stock, and then you would do exactly the opposite of what you would do as seller of the asset compared to what you would do if you would have bought the asset. So if you buy an asset and there is a dividend payment, then you receive that dividend payment. That's a cash inflow. If you have short sold the asset, then it means that in case of a dividend payment, you need to provide the dividend to another party. And then this will flow from the margin account to the other party. In case the asset is a bond, well, usually bonds receive coupon payments. If you are the holder of the bond, then you receive the coupon payments. If you have short sold a bond, then it means that in case of a coupon payment, you have to provide the money of the coupon to the other party again. So also with short selling assets, there is potential future liabilities, and because there's a potential future liability that you have to pay something as short seller, there will be a margin requirement again. And the margin requirement, so the initial margin requirement for short sale is 150% of the share value. But given that you already sell the asset and the proceeds of selling the assets will flow to the margin account, you already have 100% there. And so on top of that, there will be a request of 50% additional. And there will be a maintenance margin of 125%, which basically means that as soon as the margin account drops below the 125%, there will be a request from the broker to the trader, to the short seller, to add cash to the margin account to assure that the total cash in the margin account facilitates the 125% of the share value. So let's look to an example. Let's look to an example where in April a trader requests a broker to short sell 500 shares with a share price of $120. So that means that's actually in total a value of $60,000 that will be received by doing that. That in May there is a dividend payment of $1 per share, which in total means a dividend payment of $500. And in July, the trader requests to close out the position, so it requests the broker to buy 500 shares in the market in July. If at that case, in this scenario, the share price is 100, that means a cash flow of 50,000. So let's see how in this example the margin account works. So in April, the 500 shares are short sold against a price of $120, which means a proceeds of $60,000. These $60,000, they flow immediately into the margin account. And on top of that, 50% of that value also needs to flow into the margin account, which is another $30,000 in cash that the investor, that the trader needs to provide. So in total, in April, there will be $90,000 flowing will be flowing into a margin account which is held by the broker. Then in May, when the dividend payment occurs, $1 per share, which means in total, if we have 500 shares, which means a cash flow of $500. Because the party is short the asset, it means that it needs to pay the dividends. And that means a payment of $500. And this payment of $500 will be taken out of the margin account. So the margin account was $90,000, but with this withdrawal of dividend payment now will be $89,500. Then in July, there is the request to close out the position in order to pay back to give the shares back to the party that they were borrowed from. So if the price is at that time is 100, it means that buying the shares will give you $50,000, and then these $50,000 will cost you $50,000, and also these $50,000 will be taken from the margin account, which means that then there's $39,500 left in the margin account. So what's in the end then the net proceeds for the investor, for the trader? Well, originally he has provided 30,000 in additional cash, did that in April, and now the remaining amount is 39,500. So that means that 39,500 minus 30,000 means that there is a remaining amount of 9,500, which is a gain to the trader. So in the second part, we will discuss some of the most basic derivative securities, and we will see how they function and why they are so important. Let's first talk about what a derivative security actually is. Well, a derivative security is a security where the price of that security is dependent on the value of other securities or of other market variables. So think of an option on a stock. An option is a derivative security because the value of the option is to a large extent determined by the value of the underlying stock. So for example, you take a call option on Philips, then the stock Philips could change in value, and because the stock of Philips changes in value, also the option, the call option on that stock will change in value. So its value, the value of the call, is derived from the value of the stock. Another example, a commodity future. Think, for example, of a wheat futures contract. Then wheat is the commodity. So a futures contract is a derivative security. In a moment we will say, well, it's the price that you agree upon today to buy the commodity in the future. And what we will see is that the price of the futures contract, so the price for the future, is dependent on the price of the commodity as it is today. So then again, the price of the futures contract is a derivative price because the price is determined by the price of the underlying commodity. Then a third example, a forward currency swap. A forward contract is also a derivative security because there is the currency underlying the contract, and the price of the currency or the value of the currency to a large extent determines the price of the forward contract. So if there are changes in the currency, in the underlying currency value, then that has an impact on the value of the prices of the forward contract. So the forward price is derived by the value of the underlying currency. And then the last example, an interest rate swap. As we will see later, an interest rate swap entails the exchange of a fixed rate against a variable rate, a floating rate. Very often the floating rate is, for example, the London Interbank offered rate. Also there, the value of the swap, so the price of the swap, is derived from the values of the underlying interest rate. So if the underlying interest rate changes in value, then also the price of the swap changes in value. So the price of the swap is derived from the value of the underlying interest rate. Well, derivative securities are both traded in the exchange market and in over-the-counter market, where we see that the over-the-counter market is really leading in size. So in terms of volume, it's the over-the-counter market where a huge number of derivative securities are traded. And derivative securities are very important, so are the fundamental instruments that a financial institution, but that also large corporations, will use as a hedging instrument to hedge against all sorts of financial risks, as we will see. So it's an important market from a risk management perspective, the derivatives market. So the first set of contracts that we will be looking in is futures contracts and forward contracts. They are very similar in the idea of what actually the reason is that they exist, but there are some operational differences in how they actually execute. So what's a futures contract or a forward contract? It's in fact an agreement that you enter in today, or it's an agreement that two parties enter in today to buy or sell something at a later moment in time. So you could say it's a deferred delivery sale of an asset. So I agree today about everything. I agree upon the price that should apply in the future. I agree upon what asset it will be, and I agree exactly on the moment that the asset will be bought or sold. But the agreement is today. So it's a contract that you enter in today and that will be executed at a later moment in time. And what's interesting with these futures and forward contracts is that the price that is determined to apply at this later moment in time, it's determined in such a way that both parties are happy to enter into this contract and that there is no additional premium or cash required to be paid from one party to the other party to make it a fair deal. So what it means is that the contract is simply an agreement and there is further no cash requirements or premium requirements necessary. And then what we say then is that the initial value of the contract is zero. So the price, the future price is determined in such a way that the price is fine for both parties. What also is important is that it's an agreement that both parties are committed to. So it's not an option anymore. So you may want to use this contract at a later moment in time. No, you must use the contract in time. So the contract is binding in the sense that both parties will be committed to execute the trade at this later moment in time, so under the exact conditions in the market. Well, futures contracts are huge and they are traded in a wide variety of assets. There are basically four categories. So agricultural commodities, metal and minerals, foreign currencies, and financial assets. So you see it's both on non-financial assets and on financial assets. And I will give a couple of examples to give you an idea so why these futures and forward contracts are interesting financial instruments to be trading in. So once more, it's two parties that enter into a contract, and for both parties this becomes an obligation. They must execute at the delivery date the requirements in the contract. One party we call the party with a long position, and the party with a long position commits to purchase the commodity or the underlying at the delivery date, whereas the short position commits to sell the commodity at the delivery date. And it's a zero-sum game. So what the one person needs to pay, the other person receives. And there is an important difference between the price that you agree upon today and the value that the contract has. And later on I will give an extensive example of to really make that difference clear. But the price is the price that applies at a later moment in time, and the value is to say, well, how much is such a contract worth? Is it an attractive contract or not? So the value initially is zero, which means that the contract is fair. So the future price is a fair price. Over the course of holding the contract, of course, if I have agreed to buy an asset in the future at a particular price, so say for example 100, and at that moment in time where actually I can buy the asset, the actual price in the market, for example, is 120, then you say, well, I'm very happy that I've entered into this contract maybe 9 months ago, because if I would not have entered into the contract, I would have to pay 120 to buy the asset. But now that I have the contract, I only have to buy 100 because that was the price that I agreed upon 9 months ago. So what we say then is that the contract has received value right now. So originally the value was 0, but now it has received a value, and the value is 120 minus 100, because normally I should have bought it for 120. I can buy it now for 100. So that means that the contract has delivered me a value of 20. And also there it's a zero-sum game, because the party that has gone long in this contract and that benefits from the price increase, it receives 20. There is an exact opposite party to this agreement, and that's the party that sold the contract and that shorted the contract. Because this party, well, in fact, if it would not have entered into the contract, it could have sold against a value of 120, but now it can only sell against a value of 100. So it means that the value to this party is minus 20. So again, you see what the one party gains, the long position, the other party loses the short position, 20 and minus 20. So in total, it's a zero-sum game. So what the futures contract and the forward contract does, it specifies the exact quantity, the quality of the commodity, the place of delivery, the term, and so on of the contract. So it's an extensive contract to make that clear. So let me give you an example why futures and forward contracts may be interesting. So suppose that you are a large farmer and you are growing wheat, and then you know in September the wheat will be harvested. Then of course it's crucially important that the price of the wheat at the moment of harvest is an attractive price. Well, but you don't know what the price will be because it's only in September at a later moment in time than today. Well, suppose that the farmer decides that it doesn't want to have this uncertainty about what the price will be in September, then what it could do, it could go short a forward contract to agree upon the sell price. So what it then says is, well, I want to enter into a contract today where I agree with another party at what price I can sell the wheat in September to this other party. So then you go short a forward contract. You agree today upon the price at which you will sell at a later moment in time. And you could see that from the perspective of the farmer, that's an interesting thing, because the farmer, he is specialized in growing wheat. It's strong in that, so very efficient and effective. That's where the added value of the farmer is. And the farmer is not strong in predicting what future prices of wheat will be. So that's not where its competitive advantage is. So it says, well, let's focus on that part of the business where my competitive strengths are, growing the wheat, and let's mitigate the risk there where I am not a specialist, and let's say, well, what will future prices be? So you would like to hedge the risk of these future prices, and one way to do that is by entering into a forward contract, selling the forward contract. Now, second example, consider a miller who regularly requires wheat as input to its business process. Well, so this miller actually takes the opposite position from the farmer, because it also says, well, I'm very good in working with wheat, so I have an excellent process to transform this wheat in products that then afterwards will go to other parties. But there is a risk that the price of the material that I need, the wheat that I need as input to my business process, that price will rise in the future, and that would be very unfortunate to me. So what the miller could do, he could say, well, I don't like that risk of price increases in the future, so I would like to agree already today with another party upon a price that we will agree upon today and that will apply in the future to buy wheat, and well, what then the miller will do, it will go long in a forward contract to buy wheat at a future moment in time. And also there, so then the risk of price uncertainty has been mitigated, because the miller knows exactly against what price it will sell in the future. So then again, so on the one hand, so the risk has been mitigated. So you are exactly clear in both examples on the price that will apply, either the price against which you will sell the good, or at which you will buy the good in the second example. There is, at moment of delivery, actually still so the unfortunate decision that you sell at the predetermined price because you have reached an obligation, and then actually the price in the market might have maybe higher. Then you would say, well, in hindsight, it would have been better that I would not have entered into the forward contract, because the forward contract turns out to be unfavorable to me. But you don't know that up front, of course. At the same time, the prices could have been lower, and then you would have been happy. So if you would look standalone to the forward contract, then you would say, well, the forward contract could have a positive value or negative value. So if I sell a forward contract, then I would be very happy if the prices would decrease, because then my contract has a lot of value. It was good that I entered into this contract, but not if prices increased. That would have been bad. So futures and forward contracts, to a large extent, they are there for the same need, to agree today upon the buy or the selling of an asset in the future. And there are some difference between the two, and the most important I've stated here. So a forward contract usually is executed in the over-the-counter market, so between two specific parties. So it can also then be far more tailor-made to the needs of both the parties. There is no active secondary market, and what I mean by that is once you enter into that contract, it's not easy to get rid of the contract after a couple of months. So usually what happens is that you sit out the contracts until well, the actual delivery of the goods at the maturity moment of the contract, at the execution moment of the contract. So you could not easily say, well, now in hindsight, market circumstances have changed, let's cancel the contracts. What happens, say, when there are the bilateral negotiations between the two parties that enter into the forward contract, there may be clauses in there under what condition that the contract could be stopped intermediary, but it's a far more complex activity than when you would enter into a futures contract. So futures contracts are far more standardized contracts, so less tailor-made to the needs of both parties. They are exchange traded, and it's very easy to enter into a futures contract, but also to step out of a futures contract. You could do that on an hourly basis, daily basis, and because they are far more standardized, it's easier to do that. What happens with the futures contracts is that the actual delivery of the goods, so the actually buying or selling of the good, usually doesn't take place, but the position is closed out before the actual delivery. So only 1 to 3% of the actual delivery of the commodity will take place. So what does that mean? I agree with a counterparty on the delivery of a good at some moment in the future. We enter into a futures contract, and the futures contract initially is a fair contract, so it has a value 0. During the life of the contract, there may be gains and losses on the futures contract, so the futures contract may become relatively attractive or unattractive to these parties, and that's immediately cash settled, which means that just before the actual delivery, there is already an advantage or disadvantage from that contract, which has been dealt with by a cash payment. So which means that the actual delivery in the end doesn't need to take place, but simply the contract is cancelled and then the cash is paid instead of the actual delivery and then the buying or selling to get the cash. So I have an example of how, in this case, forwards are quoted. So let's look to the table in the top right position. The table has is for spot and forward quotes for buying British pounds, GDP. And so what then the amount is that needs to be paid in terms of US dollars. So it's the US dollar GDP exchange rate. How much dollars do I pay for 1 British pound? And then there are 3 columns. The first column says, well, what the moment is of the agreement. So it could be a spot rate, which means that, well, we are looking to buying or selling today. The numbers that you see in this table are all from the perspective of a market maker. So the market maker will buy 1 British pound, for example, for $1.2732 today. Because if a market maker buys something, then it buys against the low price, so it buys against the bid price. So that's what you see, that's the bid column. The first number there is the spot price. So how much could you then, you take the opposite position from the market maker, receive if you want to sell 1 British pound? You could receive 1.2732 because the market maker is prepared to buy today against that number. You could also decide that you want to buy or sell British pounds at a later moment in time. So again, the table is from the perspective of the market maker, and for example, the market maker will agree today, because that's what the futures or forward contract does. It agrees today to sell 1 British pound in 1 year from now for $1.2889 US. So a market maker that sells against the high price, so that's the offer price, and then you look to the third column to the number, say that comes with the 1 year forward rate, so it sells against 1.2889. So it's a commitment that both parties then will honor. And again, you as an investor take the opposite position, you buy then forward in 1 year from now. And then as a third example, so a 3-month contract, we agreed today, the market maker could agree today to buy 1 British pound in the future. It does it again against the low price because it always buys against the low price. So the 3-month forward against the bid is 1.2772. Just to give you an idea of how to read this table. So once more, it's from the perspective of the market maker. So that means that you as a counterparty that wants to enter into a trade needs to assume exactly the opposite position from the market maker. So when the market maker buys, then you sell, and vice versa. So what I will do in the next couple of slides, because I believe that's really a very important phenomenon that you have to understand, well, you need to have a deep understanding about this, is that whenever we talk about futures and forward contracts, there are actually 3 relevant things that could be easily confused when you talk about futures and forward contracts. And that is, a futures contract could have a price. There could be a cash flow associated with a futures contract, and the futures contract could have a value. And the same applies to a forward contract. The forward contract could have a price, there could be a cash flow, and there could be a value. And in particular, the subtle difference between the price of a contract and the value of a contract is an important one that should not be confused. So what I will do is I will first give you the idea and formulas, and then afterwards I will have an example both for a forward contract and for a futures contract with actual numbers that you see how the prices, the cash flows and the values develop with both a forward contract and a futures contract. To begin with, there is a distinction if we look to a commodity or an asset, there's a distinction between the spot price of the asset and the futures price. So we are today at time small t, and then the spot price is denoted with PT, and that's the price that prevails for the asset today. That's the price if you would buy the asset today at time t. Next to that, today at time small t, you could also enter into an agreement then that agreement would apply to a future moment in time, and that future moment in time we will denote with capital T. And the agreement is a price that would be agreed upon today at time small t, and that would apply at a future moment in time, the large T, the capital T. So it's important to have this notation right. So, as I mentioned earlier, whenever a futures price initially is determined, then it's determined in such a way that the value is 0. But if I actually come at the maturity moment of the contract, then there was the original contract which had a value of 0. But there could be that, say, at maturity moment, the contract actually has received a value, and that's why if you look to a futures contract or a forward contract as a standalone security, so there could be value that is associated with this position. So if I have a long position in a futures contract, I engage into the futures contract at time 0. So at that time, the price that has been determined for delivery at time capital T is F0 capital T. If I look to a futures contract at time capital T for the delivery at time capital T of that same security, then actually what you say is, well, that is the future spot price that is applying at that moment in time. So that's capital P at time T. So if I enter into a contract, then originally the price that applies is F0T. Then if I actually come to moment capital T, then the price that really in that market is applicable is the spot price PT. And if I'm the holder of a long position, then I profit from this contract if I would look to this future or forward contract as a standalone security, as the difference between the actual price that prevails in the market, PT, minus the price that I agreed upon today. So I agreed upon that I could buy the asset for 100. The actual price in the market is 120. So originally this contract had a value of 0, but now at time capital T, the value has become 120 minus 100 is 20. Same applies for a short position. It's a zero-sum game. So exactly the opposite applies. So there the short position is taking the minus from the long position. So I originally agreed upon a sales price of F0 capital T. So today at time 0 I agree upon a price that applies at time capital T. If I actually come to time capital T, and I would enter into a forward futures contract or forward contract, then that price would be F capital T for delivery at time capital T, which is simply the spot price at that moment in time. And I take the difference between the original agreed upon price and the actual price that prevails in the market. And so if the price actually has been risen, then I make a loss. So the price so we agreed upon a sales price of 100, but the actual price in the market now is 120. Then for the short position, if he would look to this contract on a standalone basis, and he says, well, this is unattractive for me because now I make a loss of 20 because I only can sell at 100, but the price in the market is 120, so a loss of 20. And that's what these graphs show. So on the x-axis, you see the spot price at the maturity moment of the contract. So if at the maturity moment of the contract the spot price is exactly equal to the price that we agreed upon when we issued the contract, which is the F0, then the profit on the contract is exactly 0. If the spot price at maturity moment, so the PT, is higher than the pre-agreed on price, then the long position makes a profit. If the spot price is lower, then the long position makes a loss. So that's what the blue line does. You both can make a profit or a loss if you consider the futures contract as a standalone security that you enter into. The second graph shows the holder of the short position, which is exactly opposite to the long position. So the buyer has the first graph, the seller has the long graph. It's a zero-sum game. So what the one gains, the other one losses. And what the third graph does, it shows the payoff diagram for an option, which we will discuss later. But there you see there is upward potential. So there is a potential of a loss, but as soon as the option cannot be executed, there is no loss. So there is a bottom for the loss. So this is a contract that's always favorable for the holder of the option, and because that is the case, this payoff diagram is not for free, but the option holder needs to pay a premium for it up front. Whereas with the futures contract, both the long and the short party say don't have to pay a premium, but instead they could either make a profit or a loss, again, if you would look to the futures contract on a standalone basis. So what's the difference between a forward contract and a futures contract? Well, the most important difference is that the different way the cash flows occurs. The different moments at which a gain or a loss is recognized in terms of a cash flow from one party to the other party. So with a forward contract, during the life of the forward contract, the contract builds up value, and this value is only settled at maturity moment. Whereas with a futures contract, what happens is that on a daily basis, there is a settlement of the gains and losses, which we call marking to market, which means is that at each moment, at each day, there will be a transfer from money from one party to the other party's margin account. And then what will happen is that the old futures contract will no longer apply, but there will be a new futures contract instead, which has the same remaining time to maturity, but only the price will change. So there will be an adjustment for the price that will be agreed upon for the future on a daily basis. And at the same time, there will be the marking to market, is that the profit or the loss that would have been already gained or lost is also settled then on a daily basis. So in principle, so the cumulative gain of these daily settlements with the futures contract is exactly identical to the overall value that's built up in a forward contract and then held until maturity. But simply say the recognition, so the cash flows of these daily gains and losses are different. So first example, let's look to a forward contract. And as I mentioned, there's three important elements that we need to distinguish. The first is the price that applies to the forward contract. The second is the value of the contract. And the third thing is any cash flow that could happen. So we look to a forward contract that is entered into at time 0. And the maturity moment is time capital T. And I will distinguish three typical moments. So I will look what happens at time 0, at the initiation of the contract. I will look what will happen in between, all moments in between, and I will look at what will happen at maturity moment. So at time 0, the price that is agreed upon at time 0 and that applies to time capital T is determined. And we call that F0. So it's a price agreed upon at time 0, and that applies to time capital T to buy or sell a particular good. So then the value of this forward contract at time 0 is 0, and I denote value with a small f. So that means that this contract is a fair contract. Both parties are happy to agree upon this price for the forward to apply for the future. So there is no need for any transfer of cash between the two parties. The value of the contract is a fair contract. It has value 0. So that also means that there is no cash flow at time 0. So there's no money transferred from one party to the other party. So then what happens over the life of the contract is that one day later or 1 month later, I could again enter into a forward contract. And then, of course, market circumstances could have changed. And that means that the forward contract that would apply at time small t could be different than the price that originally was agreed upon. So it could be the case that I was lucky that I already agreed upon a price at time 0, because now the price is much lower, or maybe I was unlucky. Sorry. It could be the case that I am happy that I went long into the forward contract and I agreed upon the price already at time 0, because if the price increased, and I would only enter into the contract at a later moment in time, then the conditions would have been worse, so I could benefit from it. So what happens is that if at a later moment in time the new conditions to enter into a forward contract mean that the price to be agreed upon is a higher price, then you are very happy with your original contract. And that also means that that original contract now has value. And we denote that value with a small f at time t. And it's simply the difference between the price that you would agree upon on time small t compared to the price that you agreed upon on time 0. So your contract starts building up value. So there is no cash flow, so it's not like this value is then paid out in terms of profit or losses between two parties. No cash flow in between. Then you arrive at maturity moment. At maturity moment, the forward price is equal to the spot price at that moment, and we denote that with F capital T. At that moment, there will be a cash flow that occur to actually pay out the build-up value of the contract, and the cash flow is exactly the difference between the price that you would pay in the market at time capital T, so the spot price, which we denote with Ft in this case, but which is equal to Pt also, compared to the price that you originally agreed upon. So the cash flow then, say, is paid out, and because the cash flow has been paid out, the value of the contract has gone back to 0. So let's look to that in an example. In this example, we look to a forward contract which has a 12 months maturity. So in the first column, you see the month that you're in, month 1, 2, 3 until month 12. The second column shows the price, the spot price of the underlying. So it starts with 40 and then increases to 40.49 and further. And then in 12 months from now, in this scenario, the price is 44.74. Then in the third contract, there is the price of the forward contract. So what it really means is that if at time 1 I want to enter into a forward contract to apply for moment 12, so that's the maturity moment, then I could agree upon a price of 41.46, where both parties agree to buy and sell at time 12 against a price of 41.46. And it's a fair contract because the fourth column shows the value of the contract, the small ft, and that value is 0. And then the last column shows the cash flow that is associated, which is 0. So let's look 1 month later. 1 month later, we see that the spot price increases to 40.49. And then if I would like to enter into a forward contract 1 month later, say at time 2, for the delivery of the buy and selling of a good at time 12, then we see that the market conditions have changed, and then now that the price that could be agreed upon for this buying and selling at time 12 has become 41.83. Well, if you already entered into a forward contract at time 1, then that actually makes you very happy, because you say, well, it's good that I already entered into this agreement, because that agreement that I already entered into is far more favorable than the agreement that I would be entering into if I would have done it at time 2. And actually what we say is, well, we are going to look to how much value our original contract has built up now, because the new futures contract, new forward contract, would have a value of 0, but given that I have an old forward contract, it has a value, and the value actually is the difference between the forward price at time 2 minus the forward price at time 1, which is exactly 37 cents. So that's why in the fourth column with the small ft, you see that there is now a value in the contract. So your original forward contract has value. So if we go a little bit further, so suppose that you go to time 5, there we see that the futures contract has gone, well, if I would enter into a futures contract at time 5 to deliver a good at time 12, then the price would be 41.27. Now you say, oh, well, actually, I'm not very happy that I already entered into a forward contract at time 1, because if I would have waited until time 5, the conditions would be far more favorable. I could have agreed upon a price of 41.27 to apply at time 12, but instead I agreed upon a price of 41.46. This means that the contract, your original contract, now has a negative value of minus 20 cents, and so on. So let's look what happens at time 12. At time 12, the spot price and the forward price are equal to each other, because if I want to enter into a forward contract at time 12 to deliver a good at time 12, then actually it's an immediate delivery, which means that I deliver against the spot price, which is 44.74. So also the forward price is 44.74. And then actually the total value that's built up is the 44.74 minus the 41.46, which is the original agreed price. And at time 12, the total value that has been built up, so the difference between the price that prevails at time 12 minus the price that I agreed upon at time 1, the difference between the two is 3.27. And at time 12, so at the maturity moment, it's actually paid out. So that means that there will be cash flow of $3.27. Once the cash flow occurs, it means that the remaining value is set back to 0. Now let's look very similar to how we did with forward contracts, how this works with futures contracts. So with futures contracts, I'm also going to look again to these 3 elements: the price of the futures contract, the cash flow of the futures contract, and the value of the futures contract. And again, there is an important difference between the price of a futures contract and the value of the futures contract, as we will see. We will look to 3 typical moments in time. We will look to the moment of entering into the contract. This moment we call time 0. We will look to all the intermediary moment, which I will call time small t. And we will look to the maturity moment, which is time capital T, which is on the next slide. So at time 0, I enter into a futures contract and I determine the price. So that's the price that I agree upon at time 0, and that applies to time capital T, which is the moment that the contract matures. When I enter into a futures contract, I do that in such a way that both parties are happy with the price, so that they both agree upon the price, and that it's a fair price, so that there is no additional cash flow required, so the cash flow is zero, and also the original value of the futures contract then is zero. So what happens in between? So I come to one moment later than time zero, for example, small t is time 1 or time 2. So also at that moment in time, at time small t, I could look into the market what would be the price that I could agree upon between two parties for a delivery of the same commodity at time capital T. And then what could happen is that the market circumstances are different than the original market circumstances, and it could be that, for example, that price now is higher. It changes from the price as it was before. So if that is the case, then immediately on a daily basis there will be a settlement of the price, of the gains and losses. So what would say is, well, if originally you agreed upon a lower price to buy a good, and now the price to agree upon buying the good is higher, then we will do two things. The first thing that we will do is there will be a cash flow to immediately give you the gain that you have from having entered into a more attractive contract. And the second thing that we will do is we'll say, well, our original futures price that you agreed upon will no longer apply. Instead, now actually currently existing futures price will apply for you as well. So you have settled already the gains and losses under the previous original contract. You settled it, and now your contract terms have changed in that the new price, the actual active price, will apply. So that means that a cash flow occurs and there is no value built up in the contract. The contract changes so that again the value again is zero. So every time, say on a daily basis, we will look, say, well, what are the circumstances of the new contract? Has it become more attractive, then there should be a positive cash flow to the party. Has it become less attractive, then there should be a demand for cash flow from the party. And then we change the terms of the contract, and then again we change the terms of the contract such that the value of the contract again is zero. At time capital T, the futures price is equal to the spot price. Again, if there is any change compared to the futures price one day before, then there will be a cash flow to settle for the difference, and then also the value of the futures contract again will be zero. So why is this daily settlement so important? So why is it important that on a daily basis there is a cash settlement, and then the price of the old futures contract no longer prevails, but only the price of the current contract prevails, and the value of that futures contract then is zero? Well, of course, if you do daily settlement, then every day there are contracts in the market with value zero, where there's only one price that prevails. And because these are the only contracts that are in the market, it's very easy to enter into these contracts or to get rid of them. Because a contract with value zero, you could simply decide, well, let's stop that contract because there is no embedded value in these contracts. So with an exchange traded market where people easily want to step into contracts or get out of contracts, this daily settlement assures that it's very easy to do that. Because you need to know, say, at what terms to settle, to buy or sell. Given that the value is always zero with futures contract, it's very easy to do that. That's the same as with the forward contract. Also look to the futures contract to an example. Again, I have an example for a futures contract that has a maturity in 12 months from now. The first column states the month 1, 2, 3, 4, etc. until month 12. The second column shows the same development of the spot price of the underlying good which originally is 40, and then in this scenario will be 40.49, 47.9, etc. And then at maturity moment, the spot price of the underlying good will be 44.74. Then there is the price of the futures contract. Originally, when I enter into the futures contract, the agreed upon price for a delivery for buying and selling at moment 12, at month 12 is 41.46. And you see that in this scenario, the futures price develops over time, 41.83, 42.01, and so on. And in the end, at time 12, the futures price is equal to the spot price, because if I agree upon the delivery of a good at time 12 and if I agree at time 12 to deliver a good at time 12, because that's what the futures contract does, that's actually the immediate delivery of the good. So which means then I take the spot price at time 12. So the 44.74, the spot price, is then also the futures contract price. So what happens on a daily basis? There's daily settlements. So originally at time 1, I agreed upon a price of 41.46 for a delivery at time 12. If 1 month later, at time 2, if I would want to enter into a futures contract for the delivery at time 12, and then the price would be 41.83, then you say, oh, I'm a very happy person that I already entered into this futures contract at time 1, because I agreed upon a lower price, so I could buy it cheaper, which means actually that the contract has value, but this value is immediately settled. So the difference between the new futures price at time 2 against the original futures price at time 1, 41.46, the difference is 37 cents. So that's immediately settled. So there is a cash flow, actual cash flow that's occurring to the holder of the long position, from the short position to the long position. And then also the second thing that happens is that the original futures price of 41.46 no longer applies. But instead, the conditions of the contracts all stay the same except for the futures price. So now the holder of the original futures contract will have a new price that it needs to agree upon, which is 41.83. So then 1 day later, at 1 month later, at time 3, so market circumstances are now such that if I want to buy, I want to agree upon the buying or selling of an asset at time 12, and I want to do that at time 3, then the price that I can agree upon is 42.01. Well, at time 2 and month 2, you had agreed upon the new conditions as a long holder of 41.83. So again, you say, well, I'm still very happy that the conditions have further deteriorated as for the new buyers of the futures contract, because I have an old futures contract which is far more attractive. Again, there will be a settlement taking place, so that means that the difference between these two values, the 18 cents, will flow to the holder of the long position. And also there, what will happen is that the existing futures price that was agreed upon, the 41.83, no longer applies, but instead the new price of 42.01 applies, and so on. And then in the end, at time 12, the same thing happens at all previous moments. And so there's the last settlement taking place, because the latest active futures price that was agreed upon for delivery at time 12 is 44.38. Well, at time 12, the spot price is 44.74, which is then also the futures price at time 12 for delivery at time 12. So then there is again a 36 cents increase in attractiveness, which will then flow as a cash flow to the long position of the futures contract. Then, if I add up all these cash flows in the last column, I get to 3.27, which is exactly the same amount that the holder of the forward contract had under the same scenario. The only difference is that with the forward contract, the cash flow only took place at time 12, which was once and for all 3.27, and instead with the futures contract, it develops over time. So we next move to swaps. Swaps are slightly more complicated if you compare them to futures and forward contracts. Swaps are very relevant derivative securities that are used extensively, for example, by pension funds, which have a long-term view on cash flows, which have multiple cash flows over long term that will occur. And in particular, say interest rate swaps and currency swaps are important financial derivatives to large institutional investors, because for a long period of time, so multiple moments in time, they are exposed to interest rate risk and to currency risk. So swaps in particular are used as balance sheet protection, because if you think of a balance sheet and the value on the balance sheet, then it's not so much the assets and the liabilities that are on this balance sheet not necessarily apply only to one moment of time, but in fact they are the present value of multiple future cash flows. So to give you an example, a bond portfolio has many different cash flows occurring, so coupon payment and principal repayments. For example, a 30-year bond has at least 30 yearly payments, or if there's half-yearly coupon payments, and there are 60 payments in the future. So that's 60 moments in time where cash flows could be uncertain and could be hedged, and it's the present value of that which then arises in the balance sheet. But same with liabilities. If I look to pension liabilities, then the pension fund knows that in the future it will have to pay out, say, pension income to retirees. And this is a long stream of cash flows, and also that cash flow again is uncertain. And if I take the net present value of that, then that arises as a value in the balance sheet. So if there are elements of uncertainty both on the asset cash flows and the liability cash flows, then these uncertainties, which often then apply, well, have to do with interest rate uncertainty and or currency uncertainty, then the swap is the typical instrument to apply to mitigate or to hedge these risks. So what is a swap? A swap is simply a multi-period extension of a forward contract. So with a forward contract, I agreed today on, say, on the future price at one moment in the future. Well, with a swap, I agree today on a future price to apply at multiple moments in the future. And same as with futures and forward contracts, these swaps are determined in such a way that there is no upfront values, there is no cash flow required upfront to enter into a swap contract. It's simply a fair contract. So think of a swap as a multi-period extension of a futures or a forward contract. It's a very large market, the swap market, because a lot of financial institutions have balance sheet uncertainty, so have to deal with long-term asset cash flows and long-term liability cash flow streams. So they need to mitigate the risk in the uncertainty of those future cash flows. I already mentioned it. The two most important swaps that apply is a currency swap and an interest rate swap. What happens in a currency swap is that you agree on a regular basis what the exchange rate will be at many moments in the future. So that means that, for example, if you have a regular income stream in a foreign currency, then by entering into a currency swap, you agree for all these moments in the future that the foreign income will come that you can apply a fixed exchange rate for these incomes. An interest rate swap, and we will see a couple of examples in a minute, is that sometimes you know that you have to it's really a contract where you can exchange a fixed interest rate that you pay or receive for a floating interest rate that you could pay or receive, and that's related to a notional amount. And I will show you an example actually in a minute. Let's first look to how swaps are quoted. So on the top right part of the slide, there is an example. Again, the quotes are from the perspective of the market maker, so which means, say, that the investor that reaches out to the market maker assumes exactly the opposite position. So this is quotes that are made for an interest rate swap. So these are the quotes, these are the fixed rates that the market maker is prepared to buy, to pay, or to receive in fixed terms, and then to get floating. So let's look first to the bid column. So what the bid column says is, well, if you want to enter into a swap contract that applies for 2 years, then the bid says, well, the market maker is prepared to pay the fixed amount of 2.55 and then to receive floating rate during those 2 years, or it's prepared to pay floating, but then it wants to receive the higher rate of 2.58. The average of the bid and the offer rate is what we call the swap rate. And so that's in the first case for 2 years, it's 2.565. So now let's look to two other examples. Let's look to so this 2 year contract where the 2.58 applies as an offer rate means that given that in this market the cash flows occur semi-annually, so that means that there will be, in a 2-year period, there will be 4 cash flows, then what the market maker says is, well, he is prepared to receive 2.58 annualized and then to pay LIBOR annualized. And what I mean with annualized is that 2.58 annualized means actually, so that if there are semi-annual cash flow moments, that only half of the 2.58 will be received, but also that at the same time not full LIBOR will be paid, but only half of LIBOR, the London Interbank Offered Rate, will be received. And this London Interbank Offered Rate, it's a floating rate, which is uncertain. So which is every time at the beginning of a new time period, it becomes known what the value is, but you don't know what the value, all the future LIBOR values will be when you enter into the contract. So it's a fixed rate, which is a certainty, for a LIBOR rate, which is uncertain. And the counterparty takes the opposite position. Let's look to a second example. The market maker agrees for a 5-year period. So then I look to the maturity 5 to have 10 cash flow exchanges, because it's with a semi-annual frequency that cash flows occur. And he is prepared to pay 3.26, because that's the bid price, that's the fixed price, and then to receive LIBOR. And then again, what's important to say is, because this market is with semi-annual cash flows, it's not the full LIBOR that he will receive, but it's half of the LIBOR that he will receive. And it's not the full 3.26 fixed rate that he will pay, but he will only pay half of it. But then he will not do it 5 times, but he will do it 10 times on a semi-annual basis. Let's look to an example. So suppose that you are a long-term bond portfolio holder which has a value of 100 million, and that the annual coupon payment is on average 7%. Suppose that you believe that interest rates will rise. Well, then you say, well, if I just keep, so that's your strong vision. If I will simply keep my bond portfolio and don't do anything, then I will receive 7%, the par at par value. But perhaps I would like to receive more, so I'm happy to enter into a contract where I will receive the uncertain, the floating LIBOR rate. And so what I could do is, because I already received the 7% every period, so I could look into a contract where the 7% that I receive, I would like to swap that against a LIBOR rate, which is then variable, which I believe that will increase. So then what you can do then, if you really believe this, you simply say, well, let's not sell my portfolio and then buy short-term bonds in order to well, see if I can benefit from the interest rates that will change. Instead, you say, well, I keep my portfolio as it is, but I add to my portfolio an agreement to swap the 7% that I receive on my existing portfolio against a LIBOR rate. I don't know what the LIBOR rates are going to be for the upcoming periods, but that's simply the bet that you enter into. Well, given that I've added this swap to my portfolio, the payoff on the swap is that I receive LIBOR and I pay fixed the 7%. So suppose that the notional is then the 100 million. So the cash flow is then the LIBOR minus the 7% times the 100 million on the swap only. But because I also have the benefit from the 7% on the long-term portfolio, I added to that, and that means that adding this swap contract to my existing portfolio means that instead of receiving 7% fixed on my portfolio, I will be receiving LIBOR, the floating rate on my portfolio. And then of course, if you are right in your vision that interest rates will rise, then this LIBOR rate will be higher than the 7%, which means that I will make an additional income which is more than I had originally. But you are not 100% certain that it will happen. It's your vision that this will happen. Second example, let's look to a bank where traditionally a bank attracts deposits from individuals who want to save money, and then what it does with the money that it has received, it issues long-term loans to other parties. So if the bank fears that interest rates will increase, well, given that the deposits, the payments on the deposits are floating rates, so every year or every month the deposit holder gets the interest rate that then prevails in the market. So perhaps what the bank then says is, well, instead of paying these floating rates, I would like to pay fixed rates. But it's not possible to tell these depositors, well, now we agree upon fixed rates. That cannot change, so the bank simply needs to keep paying the floating rates to the deposit holders. But what it can do is it can enter into a swap contract to pay a fixed amount to under the conditions of the swap contract and to receive floating. Because what happens then is that it pays a fixed amount to a third party, the counterparty of the swap contract. It receives the floating, and the floating rate that it receives, it can exactly use to pay the deposit holders. So net effect of adding a swap contract to a portfolio of deposit holders that you have to pay a floating rate of LIBOR is that the net effect is that you pay a fixed amount. And then of course you are protected as a bank against potential floating rates that may increase. So the last derivative security that we will discuss are options, option contracts. So as I mentioned before, it's a derivative security because the value of the option is derived from other securities. Frequently used to do risk mitigation, that's what we call hedging. And then there is an important distinction between options and the futures and forwards and swaps that we already have discussed, is that the relationship between the option contract and the underlying security is a non-linear relationship, whereas, as we will see in later chapters, the relationship between the futures forward contracts and the swaps with the underlying security is a linear relationship. And that matters a lot for risk mitigation, but also say for how you need to do the risk management. But what it also does is that it, given that the relationship is non-linear, it's an attractive investment vehicle to add to your portfolio, because you could really arrive at different risk-return profiles by adding derivatives options to your investment opportunity set. Well, options are also known and say dangerously known that you could easily enter into an extreme or a significant exposure on the underlying by simply entering into the option instead. Could be large potential gains, but also large losses. So speculative strategies could be carried out there. So we see many times that people who only enter into options and do not have also position in the underlying, we call that naked positions, is that then because the option values are so volatile, could have extreme gains but also extreme losses, is that there could be extreme market movements for the holder of naked options, which is then say quite dangerous. So we need also to be aware whenever there's options in a portfolio that the risk management needs to be carried out very carefully. So what is an option contract? An option contract is an agreement between two parties. One of the party is the long position, the other one is the short position. So the long position we also call the buyer, the short position the writer, the long position or the buyer we also call say the buyer of the contract, and the writer is the seller of the contract. So if I buy the option, then it means that I have a right, but not an obligation. If I take the short position, then I have an obligation when I enter into this contract. It's also a zero-sum game, so it means say what one party earns, the other party loses. And options have many different underlying securities. Most common is stock, but could also be stock indices, currency, interest rates, futures, and so on. So basically with derivative securities and with options, so many possible derivative securities are possible. Options are traded both over the counter market and on exchanges. So let's start with call options. So what is a call option? So again, there is two parties. In case of a call option, the holder or the buyer of the option has the right to buy an asset in the future. And we agree upon the exercise price, the price against which the option can be bought, at which the underlying can be bought at the future, and we agree upon the expiration date. It's a right, it's not an obligation, so that's an important difference with a futures or a forward contract. The writer of that option contract has the obligation to sell the asset at that later moment in time against that price that it's agreed upon, the strike price or the exercise price. Well, because one party has the right and the other party has the obligation, so a right means, well, I will do it if it's attractive to me, but I will not do it if it's not attractive to me. It means that the buyer of the option seems to be in a favorable position compared to the seller of the option, who has an obligation. And because one party has a right but not an obligation, and the other party has an obligation but not a right, it means that this contract is more attractive to one party than to the other party. So for the buyer, this is a more attractive contract, and that means that the buyer needs to pay a premium upfront to compensate for this attractiveness. Next to that, a call option has intrinsic value, and so the intrinsic value means that, say, if I have the right to buy against the exercise price in the future, but the actual price in the market already is higher, it means that, say, if I would be to exercise the option already today, I would benefit from it, so it would be attractive. And that is what we call intrinsic value. Well, there's a difference between European options and American options. So that has nothing to do with the region where they are sold. So American and European do not refer to the region where the options are sold, but simply an American option. An option is called an American option when the holder of the option, the buyer of the option, is allowed to exercise the option already during the life of the contract. Very often that's suboptimal to do that. It's better to wait until the maturity moment in that case. With a European option, you are only allowed, the buyer of the option is only allowed to exercise at expiration moment. So if the holder of the European call option wants to do something earlier, well, given that the prices, the values of these call options are updated on a daily basis, what he could do, instead of exercising the option, he could simply sell the option in between. Exercises only at the maturity moment. Let's look to an example. Let's look to a call with an exercise moment and a maturity date of January 2040. It's a call option. The underlying asset is IBM stock, and the exercise price is 130. So that's the agreement that the holder of the call option could buy IBM against a price of 130. So this option was bought on December 2nd, 2013, and because it's a right and not an obligation, the holder of the option, the buyer of the option, needs to pay a premium for that, $2.18. And then the option expires then actually in January, and that's the third Friday of the month. And now let's look to two scenarios. In the first scenario, IBM, the stock of IBM, the underlying, remains below the 130. Well, the holder of the call option says, well, I have a right but not an obligation to exercise the option. If the value of the stock is lower than 130, then it's more attractive for me to buy the asset directly in the market than to exercise my option and then to pay 130 for it. So I will not do anything. I will not exercise the option. So let's now look to this call option as an individual security. Then you say, well, I originally paid $2.18 for the security. Now at maturity moment, I see that the option has no value or zero. So that means that I lose my full investment of $2.18, which is a loss of 100% basically, if I would consider this option to be an individual investment. Let's look to the second scenario. In the second scenario, at maturity moment, the IBM share raises to $135, which means that now the option actually is attractive. I would like to exercise it, because if I exercise it, I can buy the IBM stock for 130, whereas in the market it would cost 135. So I could say, well, let's buy it for 130 under the option conditions, and let's sell them in the market. I would make a benefit of $5. So you don't actually have to exercise the option and then to sell it in the market, but you could automatically simply have a cash settlement on the call option itself. So that means, say, that the call option at maturity moment has a value of 5, which means that originally you paid $2.18 for this option, and you then basically make a profit of $2.82 at maturity moment. That means a return of 129%. So you see there could be huge losses and huge gains if you enter into a call option and you consider it as an individual investment. So then some formulas. The intrinsic value of a call option is given by C at moment T. Is that you say, well, I look to the difference between the exercise price that I've agreed upon, X, and the actual price that prevails. So that's the ST, the spot price in the market. And I have a maximum operator there. So only when ST minus X is greater than 0, it has a positive value. And otherwise, the value will be 0. So there is a bottom in the value of the call option of 0. So that's different from futures and forward contracts, where the value could become negative if you are the holder of a futures or forward contract. With a call option, the value is 0 or higher. So that's the intrinsic value. The intrinsic value is, well, if I exercise the option, what's then the value? It's positive value when the actual price of the underlying share is higher than the exercise price, and otherwise it's 0. During the life of the call option and also at maturity moment, we could say that the call option is in the money, at the money, or out of the money. And that really is the case if the price of the underlying security is higher than the exercise price, is equal to the exercise price, or lower to the exercise price, respectively. That gives you some sort of the intrinsic value that that's available. So here is an example of a call option on an underlying where the exercise price is 100, and originally to enter into this contract the holder of the call option had to pay $14. Now there are two lines in this graph. There is a payoff and a profit line. The payoff line, it's the light blue line, and it says, well, whenever there is at maturity a share price which is lower than the exercise price of 100, so for example the share price is 80 or 90, then we see that the blue line is on 0. So that means there will be no cash flow payment there, because it's not attractive to do it. Then at 100, so where the exercise price is equal to the price of the underlying share, that's where the turning point is. If then the share price is going to be higher at maturity than the underlying than the exercise price, then you see that there will be a positive payoff, so a cash flow will occur. So for example, at 110, if the underlying is 110 and the exercise price is 100, then there will be a cash flow of 10. And so if the underlying is 120 and the exercise price is 10, then there will be cash flow of 20. It's linearly increasing. That's the payoff. The payoff is not the same as the profit that the holder of the option makes, because given that this cash flow payment is always attractive to the holder of the option, he needs to pay a premium for that. And this premium, so that's the original payment, was a payment of $14. So that's why the dashed black line gives the profit diagram. So you see that you start immediately with a loss of $14. Even if at maturity the exercise price is equal to the underlying, you lose fully $14, and you begin to reduce your loss of $14 if the spot price of the underlying assets at maturity is going to be higher than the exercise price of 100. So only at an exercise price well, only at a underlying share price of 114, there is the break-even point for the holder of the option to have zero profit. So you see that it's not actually at the 100 at the exercise price that the holder of the option starts making a profit, but it's further away. It's 114 because he also needs to make up for the original premium that he had to pay. Well, the writer of the option or the seller of the option has exactly the opposite position from the buyer of the option. So also here you see the payoff and profit diagrams. So with the seller of the option, the writer of the option, so at the original moment where the contract is entered into, he receives a premium. He receives the $14 as a premium, and only when the stock price of the underlying asset is going to increase significantly and will be above 114, he will start making a loss. So it's exactly a zero-sum game. What the holder of the option earns, the writer of the option, the seller of the option, loses. So we said that an option has intrinsic value, which means, say, well, as soon as the stock price at maturity or before maturity is above the exercise price, then there is value embedded in the option. So the contract has value. Say, well, if I would say would be able to exercise the option today, then I would receive a cash flow. But next to say intrinsic value, there's also something that we call time value. So it may be very well the case that during the life of the option, the underlying asset price is lower than the exercise price. So that would mean that if I would have to exercise today, the value would be zero. But then we talk about time value, which means, say, that the option still has value because there is still time for the underlying to increase and then to make the option to land into the money. And given that options always have the potential, well, given that there is always a possibility for the underlying asset to increase in value, there is always the opportunity or the possibility that the option will arrive in the money, and that's why there will always be time value, positive time value to a call option, almost always. And that's what's illustrated in this graph. So in this graph on the x-axis, there is the underlying the value of the underlying asset, and on the y-axis is the value of the option. Then there is the black line, which is zero, which is falling together with the x-axis between 0 and the exercise price, where it's out of the money. And then it has a 45-degree line going up, so when the option starts to get into the money. That's the value, that's the intrinsic value of the option. So that is, well, if I were to exercise the option today, what would be the value? Then of course it's 0 when the option is out of the money, and it's getting positive when the option starts to become in the money. So that's the intrinsic value. The intrinsic value is different from the value of the option itself, because the call option next to intrinsic value has time value. And the time value is the possibility for the underlying to further increase in value, and then for the option to get into the money. And because there is this possibility, then there is also a positive value attached to that. So the blue line is the value of the option, which is the combination of the intrinsic value and the time value. So when I need to look vertically. So when the intrinsic value is 0 and the blue line is still positive, then it means that all the value that the option has is time value. So I believe that option can increase in value because there is still time to increase. So the difference between the black line and the blue line is the time value of the option. And you see that it can be quite large. So do not only look to the intrinsic value, but also look to the time value, the possibility for options to assume higher values in the future. So everything that I've said now for call options, I will repeat for put options. Put option is also an agreement between two parties, but instead of looking to a right to buy an option at a predetermined price, which was the case with the call option, we will look with a put option. The holder or the buyer has the right to sell an asset, and he will sell the asset at a predetermined price, which we call the exercise price, or we also know it as a strike price. And there is an expiration moment, the maturity date. And with a put option, if it's a European put option, then the potential execution of the put option takes place at expiration date. If it's an American put option, then it is on expiration date or maybe before, if that's attractive. So two parties. There is the writer of the option, the seller of the option, who has the obligation to buy the asset if the buyer at one moment in time wants to exercise the right. And the buyer of the option has the option to exercise the option. So that means that for the buyer, it's an opportunity, and for the writer, for the seller, it's a right. So that's not an equal position. The position is more attractive to the buyer of the option than to the seller of the option, which means that there needs to be a compensation for that, and that's why there needs to be a premium paid upfront by the buyer of the option to the seller of the option, which is the option premium. So a put option has intrinsic value when the exercise price is different from the actual market price. So if the underlying security has a lower value in the market than the exercise price, then it's attractive for the put option holder to exercise the option. So with American put options, that can already happen during the life of the option contract. Also there, very often it's far more attractive to wait, because the situation may become even better. So we say then it's suboptimal to exercise early. And with a European option, you can only exercise at maturity moment. So if you say, well, as a holder of a put option, that you want to get rid of the option earlier, then instead of exercising the option, you could also simply sell the option, because it's the option premium is determined say on a very high frequent basis. So you could simply give this right to another party who then pays you the premium instead of you exercising the option. Let's look to an example. So I look to an example where there is a February 2014 put with an exercise price of 195, and in order to buy this put, the put holder needs to pay $5. So that's the option premium that needs to be paid, because the holder of the put has a right and the seller of the put has an obligation. So there is an expiration moment, 15th of February, and let's look to two scenarios of what could happen at expiration moment. First case, what could happen is that the IBM share price remains above 195. So well, then if you want to sell IBM, it's more attractive to sell it against that higher price than to exercise the put option and then only to sell it against 195. That means that the option is not attractive at maturity moment, and it means that it has no value at maturity moment. Originally, you paid $5 to enter into this option, which means that you lose the total initial investment of $5. You don't get anything in the end, so you make a loss of minus 100%. In the second scenario, IBM drops to 189. So for the put option now, it becomes attractive to exercise because under the options, under the put option conditions, he's allowed to sell the underlying for a higher price, for 195. That's the exercise price. And then again, there is usually cash settlement on put options, so it's not like he first needs then to sell it against the lower price and then to buy it against, well, sell it against the higher price and buy it against the lower price, but that's immediately done by a cash settlement. So there will be a cash settlement of $6 on this put option. Then in terms of profit, so the original investment, the original premium that was paid to enter into this contract was $5. So he gets at expiration, he gets $6. So he makes a profit of $1, which means 20%. So also here you see that if you consider put options as individual investments, so the returns could be very high or very low. So in this case, you could lose 100%, so it's a return of minus 100, or in the second scenario, you could gain 20%, plus 20%. So a put option has also, like with call options has intrinsic value and time value. Let's first look to the intrinsic value. The intrinsic value is the difference between the exercise price that was agreed upon and the actual price of the underlying stock, but only if that amount is positive. Otherwise, it's limited to 0. So we look with the maximum operator to the difference between the exercise price and the underlying stock price, and 0. So that means that if the stock price is actually below the exercise price, then this option has value X minus ST. If it's above the exercise price, then it's not attractive to exercise the put option, and the value is 0. So it's very similar to call options. A put option can be in the money, at the money, or out of the money. That's exactly the opposite from how it works with the call option, because a put option is in the money if the stock price is below the exercise price. With the call option, it was when it was above. But here, with put option, in the money when the stock price is below the exercise price, at the money when the stock price is equal to the exercise price, and out of the money if the stock price is above the exercise price. Let's look to the following diagram. In this diagram, there is both a payoff and a profit line for the holder of the put option. On the x-axis, you see the value of the underlying asset at maturity, and on the y-axis is the value of the put option at maturity. So there is in fact a profit or the payoff associated with holding of the put option. So same to call options, but then in a different case, is we see that if the stock price is higher than the exercise price, then it's not attractive for the put option holder to exercise the option. So the blue line is then equal to 0. If the stock price starts to be lower than the exercise price of 100, then it's attractive to exercise the put option, and we see that the value then starts to increase. So if the stock price in the end would go to the extreme that the underlying stock price is 0, then the put option would be worth 100. So you see that the blue line gives the payoff where it starts to become positive when the stock price is below the exercise price, and it's 0 when the stock price is above the exercise price. The payoff and the profits lines are not the same to each other, because with the profit line, we need to take care of the original investment, the original premium that the buyer of the put option had to pay to the seller of the put option as a compensation for the fact that he has a right and not an obligation. And also we see here that it's not at the exercise price that the profit is zero, but there it's still negative. So the stock price needs to drop below, well, significantly below the exercise price before the option gets a positive value, gets a profit. So it's an important distinction between cash flows and profits if you look to put options, same as with call options. So next to this intrinsic value, so if you were to exercise the option immediately, there's also time value for the option, and the time value again has to do with the fact that well, if the option is not at maturity yet, then there is still time for the underlying asset to decrease further in value, and then for the put option to increase further in value. So that also means, say, that if there is an out of the money put option, so the intrinsic value is zero, then there is still time for the option to get positive value, and that's why put options still have values which are positive even if they are out of the money, but when expiration moment is not there. So let's look to an example again. So in this graph, actually there's two graphs. There is the time value that is there on the right hand side of the X. So we see that when the put option is out of the money, which is the case when the underlying stock is larger than the exercise price, then the intrinsic value is zero, the option value is positive, and that's fully due to time value. So fully due to the opportunity for the underlying stock to further decrease in value, and then for the option to get into the money, and then for the put to get value. And then we see as the underlying stock value becomes further into the money, we see that the time value decreases further, and at one moment in time the time value is almost zero, and then the value of the stock, the value of the put is equal to the intrinsic value of the option. And that concludes this lecture. I thank you for your attention.